Hey, it's Dave. So, following up to my market crash, housing crash video from yesterday, if there is going to be a crash in real estate, it's going to be in this area, and that is in commercial real estate, specifically in office space. So, there's been a lot of rumblings and mumblings about a potential looming disaster coming in commercial mortgages. And that has to do with obviously with the pandemic and work from home and all of that kind of stuff. We've had a lot of office space that is no longer being used, no longer needed. Vacancies are huge right now, and a lot of leases are not being renewed. And if you know anything about commercial lending, those loans, the loan to value and how they evaluate a property in terms of what its worth is, instead of doing a comparative analysis like they do on residential real estate appraisals, they do an income approach. So the more net operating income that a building has, the higher its value. You take that net operating income and you multiply it by a cap rate, which is kind of the going rate that people are willing to pay, as a multiplier of income in the area, and that gives you a value. So when you have a bunch of vacancies, when people are not returning to the office, when leases are not being renewed, you end up with a lower net operating income on that building, and therefore that building is worth less. Now, this wouldn't be a huge issue if loans for commercial buildings were done the same way they are for residential. If you could have locked in a 3% interest rate for 30 years on, a $20 million office building, that would be great. But banks don't lend that way on commercial property. They do things in a lot shorter terms in terms of when they want their money back. They don't want it back in over 30 years. They want payments for 5 to 7 years and then a balloon where they want that money back so they could redeploy it at different rates. They don't want to be tied up at 3% for 30 years. They only have a crystal ball that's, 5, 7 years out. And so even though they'll amortize loans over 20, 25 years, they won't let you keep the loan until you pay the whole thing off in that period of time. So what you have is, let's say 2018, 2019, they're doing loans on this based on a full capacity office building, and that now is coming due in 2023 or 2024. You have a lower income now when you look at your net operating income in that building when only 50% of it is full or 70% of it is full. So actually, let me draw that out for you, and so you kind of see what I'm talking about. So let's say you had a cap rate, or let's say you had a net operating income of 100 grand on a property, and the cap rate for that area was 5%. Oh, you can't even see me, can you? Let me move myself. Sorry about that. So, and the cap rate, that's a whole other video on how that's determined. Its market factors, its competition. What are people, how many people are buying in that area? But basically, the math ends up being that if you're generating a net operating income, and your cap rate is of 100 grand and your cap rate is 5%, that building is worth $2 million. And so you could go to a bank, they would analyze all of this and, say, we're going to lend you 60% of the value of that property. And so they'll give you a loan for $1.2 million on this property. So you fast forward, and that, by the way, that's probably amortized over 20 to 25 years, meaning your payments are calculated, per month for those that many months, and your interest rate would be like it might be good for the whole term, but it would be a 5 or 7 year balloon, which means you pay it for 5 years. It's calculated over the 20 or 25 years, but you got to get a new loan or you got to pay the whole thing off in 5 years. And so in that 5 years, let's say you did this in 2018 or 2019, the pandemic is nowhere in sight. You don't know that people are going to all of a sudden do Zoom calls and work from home, and at most some offices are work 3 days. They've gotten rid of all the offices and they just have spots for people to work at because they never know who's going to actually be in the office. There is a really low demand for office space right now. So your net operating income could be down 30% to a $70,000 a month net operating income, which if the cap rate stayed the same, and cap rates have gone up, which is bad for values. It works in opposites, but because there's no demand for people to buy office buildings, your cap rate is going up. That multiplier is not as favorable. But let's just say it stayed the same. And you had a 5% cap rate at 70,000. So 70,000 divided by 5%, 1.4. So now this building is worth 1.4 million, and you've got a 1.2-ish loan that you have against it that needs to be refinanced. They're not giving you another 1.2 million loan. They're going to give you maybe 60% again, which would be about what, 80 grand? 70, let's see, times 0.6, 840 grand. And so you're $400,000 in the hole when it's come time to pay that loan off. These are even small numbers. There's not a lot of $2 million office space. You're talking, $20 million, $40 million, $100 million properties with lots of big, heavy loans on them that are coming due over the next 3 years. And if rates continue to stay the same and the income is low, you're going to have a lot of people in trouble. So that's kind of what has been rumbling around. I've seen a couple of different segments on the financial news TV channels. I found this article that kind of talked about how some of the banks actually added to their exposure in 2022. This is from the S&P Financial. So you're looking at actually S&P Global. You're looking at where banks, even as recently as 2022, were adding to the amount of office, not commercial. So there's commercial loans are different than residential, but in commercial you have like industrial loans, you have office space, you have retail, you have multifamily, you have different segments within commercial, but they're kind of all lumped in as commercial loans. But this article specifically talks about office space and how banks have even increased their exposure in 2022 to that. And we've known since the pandemic started that office space was going to be under some pressure. But so like here it says office loan exposure was an often cited concern in the fourth quarter. On several different earnings conference call with several executives saying their banks are taking steps to account for elevated risks in the sector amid weakening demand and challenging economic conditions. And so this chart is kind of strange. This is where the year over year change in 2002, these banks, these are their ticker symbols. You can pause your screen if you want to look them up. I looked up a handful of them and they've all dropped pretty good in the last, since the Silicon Valley Bank failure about a month ago. A lot of these stocks are down 30% in the last month and a half. But so these are the ones that added. And this bottom line here, this is a percentage of their total loan. So the further you go this way, this means that office exposure is a bigger portion of their commercial lending. So, these banks could be at risk. This one I happen to know is this is Columbia Bank, who's recently announced a merger with Umpqua. So that'll be interesting to see how that plays out. This is Wells Fargo Bank over here. And you'll see that a little bit closer as we get down. The Wells Fargo has $36.14 billion of office loan exposure, but that's only like a small percentage of their overall commercial exposure. There's some quotes from their CFO talking about, the market conditions being challenging. They're paying close attention to markets like San Francisco, LA, Washington, D.C. And then here's kind of like the number of how much outstanding office loan exposure they have. Wells Fargo, they're a too big to fail bank. That this looks like a big number, 36 billion, and it is a big number, but it's not. They don't have a large exposure to their overall. It's looking at like under 4% of their overall gross exposure to commercial loans. So, but anyways, I thought it was interesting to see like a list of names that could be overexposed maybe to office space, and I'm going to keep an eye on this, and we'll just see what it ends up doing to the market. We'll see if there's any contagion on it as far as like, if this is a segment and maybe it's only 3% of this bank, but it's 14% of another. We saw how the Silicon Valley Bank thing could spread once a run on banks starts to happen. Then, it's not long before they're looking to get bailed out by the government or another entity buying them and stuff like that. So hopefully this doesn't spill out, but it is kind of interesting to see how this plays out over the next month or two, and I will keep you posted as I learn more about it. Thanks for watching.